Knowing what you do about the ratios, we're going to look at how different transactions impact. So if we paid rent on a building, that would increase an expense, rent expense, and it would decrease a current asset, cash, wouldn't it? So if that's the case, then working capital would be decreased, current assets minus current liabilities. Your current ratio would decrease as well. Your asset turnover would increase. Your profit margin would be reduced because your expenses went up. Your debt to equity would increase because your shareholders' equity went down, and earnings per share will also decrease because expenses went up. Received in advance payment from a customer for services to be rendered over the next 6 months. There, your current asset cash would be increased, as would your current liability, unearned rent, or no, unearned payment, or unearned payment received in advance, unearned revenue, deferred revenue. So all of those are current liabilities. So if that's the case, working capital is unchanged because current assets went up as much as current liabilities. So when we're doing a subtract, there is no difference. But when you're doing the current ratio, if both the numerator and denominator are increasing, then the current ratio decreases. The asset turnover also goes down. There is no impact on profit margin because there was nothing about revenue or expense there. Debt to equity increases because current liabilities increased. And earnings per share, no impact because no accounts were involved in that computation. If we paid salaries of employees, then what's going to happen is our expenses are going to go up, salaries expense, and our current asset, cash, is going to go down. So if that's the case, then our working capital will decrease, as will our current ratio, and our asset turnover will increase, our profit margin will decrease, our debt to equity will increase, and our earnings per share will decrease. If we buy a 3-year insurance policy and pay in full, then our asset, prepaid insurance, is going to go up, and our asset, cash, is going to go down. So notice that we're swapping one current asset for another. And if that's the case, there is no impact on any of the ratios because we just swapped one current asset for another. If we perform services for a client and receive part of the fee in cash, that means our current asset cash will increase and the remainder will be collected in 30 days, which means our current asset accounts receivable will also increase, and our revenue will also increase. So notice our current assets are increasing and our revenue is increasing. If that's the case, working capital will increase because current assets increased. Current ratio will increase because our current assets increased. Asset turnover will decrease, as will profit margin. And debt to equity will decrease because shareholders' equity increased, and earnings per share will increase. So here's some ways that transactions impact the ratios. There's more on the next page.